Hello, my name is Doug Greenberg, and I'm the president of Pacific Northwest Advisory. This presentation will walk through 15 slides to share about the current state of the economy, the markets, and where we believe the economy markets are headed. In our first slide, we certainly recognize that the Fed is increasing interest rates at the fastest rate in modern history. And that presents both some benefits and challenges. Challenges, we're concerned about liquidity in some of the treasury markets, but benefits in the fact that we may be able to, once the interest rates fully affect the economy, bring down inflation at a fast clip. We anticipate 9 months typically from the beginning of an interest rate hike to when it is fully affects the economy, not the markets. The markets have been affected, but the economy, which has been affected in some areas, like housing, but in many others has not. And we'll walk through some of those areas coming up. The economy is still growing. When we look at services PMI here in the U.S., our current reading is 56.7, and that is above the 49.2, which is the line in terms of whether our economy is growing or it's declining. Clearly, we've come down from a peak in January, but the economy is still growing despite the Fed activity. Consumer sentiment is down to a level we have not seen in decades. What we want to recall is the consumer begins to act in advance of the economy changing. If the consumer thinks or believes a recession is coming, then they begin to change their behavior to prepare for a recession, and that is self-fulfilling prophecy. It helps create that recession. The interest rate hikes by the Federal Reserve are impacting the countries across the globe. When the interest rates go up, it helps our dollar appreciate, which makes our exports more expensive, and allows emerging markets to also raise their rates. While this is occurring, we are definitely seeing a global growth outlook that is weakening and slowing, with inflation still persistent around the world. This is another reason why we made changes in the portfolio to de-risk throughout the year. This is a great chart. We have talked about cash on the sidelines. How much cash is sitting in investors' bank accounts, savings accounts, short-term money market accounts, and it's still quite a lot, despite the rise in the equity markets. So there's still a lot of what we would call dry powder available, despite the decrease in savings rates. This chart, there's a lot going on here. There are 9 leading indicators on the left. The most recent data is on the left. We should have Q3 data here in about a week. But when you look at the different indicators, it gives you a sense of what's occurring in the economy. And you can see the green is positive, the red is a slowdown, and a yellow is on its way to a slowdown. The areas down here, you can see, are still incredibly strong and really haven't moderated much from the previous quarter. This is something to watch because, again, it's demonstrating the strength in our economy. When we talk about the S&P 500, whether it's the talking heads on television or in our conversations, we talk about the valuation of the S&P 500 based on a price earnings multiple, and that's simply the price of a stock divided by its earnings, or the price of the S&P divided by its potential earnings of all the companies. And we can see that we are at a 25-year average, roughly. And when we spend time, and this is a reoccurring theme, when we spend time above our average, we spend time below our average, spend time above our average, and now we need to spend some time below. Where it goes in this -1 standard deviation area is where we expect it to end up before markets turn. We've seen um, a number of companies report over the past couple weeks, and there was a reoccurring theme through those reports. They had warnings about earnings. They had a surge in inventories. They reported a slowing global economy, and these are the results of those companies after they announced. FedEx dropped 26%, Ford 21, and Nike 12. That is what we expect to occur with earnings in the upcoming earnings period, which is starting basically tomorrow, and into the first quarter of next year, which is the reporting for the fourth quarter of this year. So a couple of slides here to kind of talk about what's going on in the underlying economy. We can see the trend line, the dotted line here, of an increase in wholesale and retail durable goods plus apparel inventory in real time. We can see that the pandemic created this inability to manage inventory in real time, and so companies kept ordering, goods were delayed, and then they came in on the backs of additional orders. And so this excess inventory has to be written down. It will help with inflation data because it will go on sale as long as consumers are willing to buy as we head into some form of a slowdown or recession. This is a chart that I think is very impactful. When the NFIB did small business survey, it showed that the small businesses who are private are having margin pressure. In other words, their profit margins are shrinking. And we expect the same to occur with the S&P 500. And if this is any indication of the decline, we would expect this to follow that same path. The other piece that we look at with companies that report their earnings is the revisions that either analysts who follow the companies or the companies themselves put out. And so you can see we have had actual decline in the consensus earning forecasts, but we don't think these are enough to equate to what we're going to see. But clearly, the downtrend, the trend is in a downtrend. This is a complicated chart. There's a lot of moving pieces on here eventually, but this is a chart of the S&P 500 in green and the U.S. money supply, the amount of money that's floating in the economy as measured by a measure called M2. So you can see at the pandemic period, we saw the increase as the government pumped money into the economy and the corresponding increase in the S&P 500. The red line is a best fit line or a trend line showing that the slope of the market is about, over this period of time, 11%. Clearly, when we look at potentially where the markets could fall, we see values at, here's 10% and here's 20, and both of those are realistic potential outcomes given history and given the amount of money that was injected into our economy. When we spend time above our trend line, we spend time below the trend line. It's a concept called reversion to mean. And although this is just since occurred in the end of 2018, this goes back throughout history. And you can see the big question is, where will this huge up take us, on the way down? Looking at it slightly differently, these are total annual returns for the S&P 500 from 2012 until year-to-date 2022. The average return over this period is 11.72%, But what's notable here is the past 3 years were above trend: 31.5, 18.4, and 28.7. So again, is this decline going to bring us back to our average, or do we need to see a further decline to negate the above average returns, to have the reversion to mean take effect? Again, when we talk about the money supply and how important it is, when the Fed increases interest rates, it is in effect reducing the money supply and attempting to slow the economy. Um, and in addition to that, the quantitative tightening that they are, um, you can see here in the green line, are undertaking is also removing, for lack of a better term, cash out of our economy. That does reduce the deficit, but you can see how it perfectly matches the trend of the S&P. And if we follow this, the quantitative easing will have some effect on the S&P 500 in a negative fashion. Again, when we look at annual returns, um, I want to again remind you that we have had wide ranges of returns throughout years. And the red is the intraday, the low of that year. And then this top is where the year finished up. So we today don't know where we will finish up. And certainly we could be, lower than our 24%, given the massive stimulus. But again, pointing out that we do have wild swings in the marketplace, and that is normal, although I wouldn't consider this current cycle anywhere close to normal. During this entire period, 1980 to 2021, the average annual return was 9.4%. So managing these downside and preserving capital on the downside allows us to have more capital on the upside. And it's a reminder that despite this turmoil of all these down intra-year declines, it's a positive 9.4% on average. I want to thank you for taking the time to view the video. Please, if you have any questions, do not hesitate to email me, and I hope you have a great rest of the day. Thank you.